you. Good morning, everyone. I'm Tracy McKibben. I'm the chair of the Finance and Risk Committee of the Authority of the New York State Canal Corporation. I'd like to welcome again all of our committee members, Dennis Traynor, Michael Balboni, Eugene Nicandri, and Anthony Pacenti. The chair of the Board of Trustees, John Canal, is excused from this meeting today. I'd also like to welcome all of our NYPA and Canal Corporation staff. This meeting has been duly noticed as required by the Open Meetings Law, and I now call this meeting to order. The first order of business is we will adopt the proposed meeting agenda, and I'd ask if any members, you've had a chance to review the agenda. We're gonna change the order of the agenda and do the executive session at the end. But other than that, are there any questions or additional amendments you'd like to make to the agenda?
I would move the adoption of the agenda as
podium though, right?
So moved. If I could get a second.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carried. Again, the agenda is adopted with the slight change of the executive session being at the end. We will now move into our discussion agenda. And first on the agenda is a discussion around our financial operations. And we will turn it, I think at this point, we turn it over. We're gonna have a risk discussion. I'd like to invite Earl Fanlagui, Senior Director of Market and Commodities Risk, to present the report for us today. Earl, are you there?
Good morning, Chair McKibben. Good morning, trustees, NYPA management team, and the public. I'm Earl Fanlagui, and I'm the Senior Director of Market and Commodities Risk. I'm here today on behalf of Adrian Lotto, the Chief Risk and Resilience Officer, and along with Adam Barsky and Scott Tenteman, here to talk about sustained margin reduction, one of the top identified risks to the organization. Chris, can you please turn to the next page? Sustained margin reduction, as defined, is caused by low wholesale market prices or the inability for NYPA to contain or reduce our costs, resulting in our inability to maintain a strong financial position in order to fund new revenue opportunities and support current initiatives. On a scale of 25, this was previously rated a 16 with an impact of 4 and a likelihood of 4 as well. The risk is continually monitored given its velocity, but it undergoes, at minimum, a formal annual risk assessment. And based on a refresh that was done earlier this year, drivers, controls, and mitigation plans were reviewed with the business and subject matter experts. And I would like to report that as an outcome of that assessment, sustained margin reduction continues to be rated at 16 and remains unchanged. I'm now gonna turn it over to Scott, who will discuss how this further impacts NYPA and the activities that we are undertaking to mitigate this risk.
Yeah, thanks, Earl. Good morning.
I'm sorry, Earl, before we go, Scott, sorry, before
sure,
you go
no problem.
Earl, one question that I had for you is, can you just remind me what percentage of our revenue comes from our merchant activity? I don't know if you have the answer to that or if Adam has the answer, just so, because that's, you know, well, that's a significant portion of what we're talking about today, right?
Currently, for this year, for 2021, we're estimating around 270, 280 million as a contribution towards our financials.
Great. Okay.
And that's out of a total of about 1.1 billion in total margin, just to give you context.
Yeah, exactly. I wanted to, so that we could keep that in perspective. Great.
It's around 30%, right, of our margin. So, you know, just to put it into context, but because it is subject to the volatility of prices in the market, it has the ability to go, you know, swing in different directions depending on where the market is. That's why we have the hedging program in place. But we'll get into this with Scott.
Good to go?
Yes, thank you.
All right, sure. Yeah, good morning, Madam Chairman, trustees, and the public. My name is Scott Tetman. I'm the Senior Vice President of Finance at NYPA, and I'm going to be continuing on what Earl already started speaking about in terms of our sustained margin reduction. I'd like to break it up into 3 quick parts. First, I'd like to talk about what's causing the sustained margin reduction. Second, how our business is changing and how the mix of margins has been changing over time. And lastly, strategies that we're employing to mitigate those effects. Before I get into that, I just want to take 1 minute and talk about why sustained lower margins are such a significant risk to NYPA's business. So I'm sure, as all of you know, NYPA is a pretty capital intensive business. We build and maintain power plants, we build transmission lines, and the pace of that capital spending has been increasing over time. If we look back prior to 2018, we were spending $250 million a year in our capital program. And we're now at a point that we're in the $750 million to $1 billion per year spend on capital. We have our Next Gen Niagara program that's going on, and we have a number of new transmission projects that we've been talking to you about. So these are all great things for the authority. They all align with our Vision 2030 and the direction that the company is moving, but they all take a lot of money to accomplish. So what we're looking for out of our operating business and our margins is stability of cash flows. We really need things to be predictable so that we know how much we have to spend, how much debt we can afford to issue and service, and make sure that we're maintaining our credit metrics. So with that said, what's causing our sustained margin reduction over time? The major focus here has been our merchant margins, and this is what we sell into the open market. And the largest driver for the decline in markets, the decline in margins, has been energy prices. If we look at the chart on the left-hand side, the blue line represents natural gas prices and the green line represents energy prices. Pretty easy to see that there's a high correlation between the two. Essentially, electricity produced from natural gas-fired plants is considered the marginal unit of generation. So essentially, natural gas sets the price of electricity in the state of New York. And in the last year and a half, you can see the dip in 2020. It's been exacerbated by COVID. I do want to point out, if you look at the right-hand side of the chart on the left, it's kind of tough to see, but there's a yellow or green section. You can start to see an uptick. We have seen natural gas prices and energy prices ticking up in 2021, which has been good for our economics. Now, the good news is, if we look at the chart on the right-hand side, this is our hydro generation in the blue and gray bars. And overlaying that, the yellow bar are energy prices upstate, so where we're selling our hydro generation. Historically, we've been about 20 terawatts a year of electricity produced out of Niagara and St. Lawrence. But as you can see from the chart, we've been between 22 and 25 terawatts. So we've had a lot of extra electricity to sell into the market. Unfortunately, it's been at lower prices. So we have gotten some relief in terms of our margins there. The result of all that, and this goes to what you were asking a minute ago, Trustee McKibben, is that if we look back from 2017-18, our merchant margins were contributing about $450 million a year. And as Earl mentioned, it's $275 million this year. So that's a drop of $175 million in terms of the contribution from our merchant margins. If we can switch over to the next page, please.
Sorry, before we go on to the next page,
sure.
One question that I had is you look at looking at these charts that you've laid out, you've focused primarily on natural gas, but we know that we are also moving in other areas like large scale renewables, as well as those are also coming online in New York State. What do you see as the impact of those conditions and how they will contribute to this low pricing pressure that we have?
I'd expect,
right?
Yeah, I would expect that would continue to keep pressure on prices and keep prices low. If we're talking about renewables, so wind and solar in particular, there are tax incentives that are given to be able to generate from those. So they tend to be price takers, which means they'll take any price that's offered. As the mix goes up and more wind and solar is coming online, I believe that that's going to keep prices lower over time, which is why this is such an important thing for us to be addressing right now.
Thank you.
Sure. If we can move on to the next page. Great, thanks. This gives us a look at how the mix of our margins is changing over time. Unfortunately, these bars were supposed to be colored on the right-hand side. So I'll just point out the really large bars represent our customer margins. They're supposed to be in blue, but you can see that they are fairly stable and growing over time. We have been looking to increase the amount of sales that we have to our customers. And we do also have modest price increases built in on an annual basis. The other bars that don't have any color are our merchant margins, which we just talked about. Those are declining over time. And I really want to focus your attention on the transmission margins in green. This is the real growth area of our business. If we look from 2019 through what we're projecting in 2024, we're looking at a $100 million increase in contribution to margins just from our transmission business. If we focus on the chart on the left-hand side, this kind of puts it more into a summary forecast, summary format on what we've looked like historically versus what we look like on a forecasted basis. So you can see customer margins at the bottom, fairly stable around 52, 55%, not really much of a move there. The merchant side of our business continues to go down. And again, transmission is bringing up our overall margins with an increase from 14 to 19%. And the other thing that I want you to take note of here is that when we're moving from merchant to transmission, we're moving from a volatile revenue stream on the merchant side because we're exposed to market forces over to what can be considered more of like an annuity on our transmission side. We have a FERC guaranteed rate of return, and we can very easily map out what our forecasted revenues are going to be from our transmission business. I think you had a question?
Yeah, one question that I had, because obviously, in addition to sort of, I like the example that you've laid out of moving from volatility to annuity, but it's also a matter of our core strength, right? This transmission work is stuff that we're really good at, the kinds of big projects that is consistent with our core. And I just want to make sure I've got the numbers right, because you've laid out that this is now going to be about 20% of our margins, our growth, our forecast, our projected growth around the transmission work that we have for the authority. And that's growing from about 5% that we are today, right? So the belief is that we're going to go from about 5%, that's the transmission driven portion of our margins, to about, as you laid out, 20%. So that's a significant growth and redirection.
No, I'm sorry. We're going from a total of 14% to 19%. It's a 5% increase, not 5 to 19.
No, the contribution to our margins is going from just 19 to 20. So the first bullet that you had, you said close to 20%.
Yeah, if you look at the chart on the left, and the green section. So right now the contribution from transmission is about 14% and it's growing to about 20%.
Oh, got it. Okay, great.
Sorry if that was unclear. Does that answer your question?
It does, but it also just highlights the fact that we are moving, dedicating some extreme muscle to an area that is consistent with our core, that we know how to do really, really well. The transmission stuff, those are big projects. And so, yeah, I just wanted to comment on that.
Do all of our transmission projects that are underway or in the pipeline, do they all have a guaranteed FERC rate of return, or are there some that are going to be subject to market conditions?
There are a few projects that we have that could be on a merchant basis, but most everything we're doing will have a guaranteed FERC rate of return before we undertake it. So our Smart Path Connect, the AC transmission project, and I know it has a new name, and I apologize, I can't remember what it is off the top of my head, are all FERC guaranteed rate of return, Trustee McCandy.
How about the offshore wind, where I've lost track, we're building transmission or substation connections for that? Is that FERC approved, and is that subject to a guaranteed rate of return?
Scott, I'll answer that one.
Great.
So, Judge, it's Adam Barsky speaking. On those particular projects that we're currently looking at, those will be done on more of a project finance basis, where we will do it use off balance sheet financing to do those. And what essentially would happen is that we would buy a portion, pay out a portion at commercial operation of a transmission line that would be built to connect to the offshore wind, let's say in this example, and we would receive lease payments back from the developer, and we would look to get a return from those payments in excess of what we would get on the regulated projects because of the increased risk associated with that. But we would obviously try to minimize our risk by keeping it on a project finance basis off balance sheet and having a good counterparty to face that would have a lease payment sufficient to pay for the financing and our return. So that's how we would be handling those type of projects. And we've got maybe two that are currently in the pipeline that we're evaluating.
Thank you.
Any other questions here? Okay, if we can just move forward to the last slide. So lastly, I just want to cover some of the mitigation strategies that we've been working on. I think we've already talked about transmission here. We do look at the blue box on the right-hand side, just for your information. These are revenue numbers as opposed to the margin numbers that were on the last page, which is why the numbers are going to look a little bit different. So I just want to make sure there's no confusion there. On the left-hand side of the page, we've been looking at new customer programs for revenue stability on our margins for that portion of our business. We have the EdCap 2.0 program. That's the Economic Development Customer Assistance Program. This is what we set up during COVID, where we offered our economic development customers the opportunity to buy more hydropower from us. It gave them stability of expenses at a lower rate and gave us stability of revenues. So that was taking some of those megawatts that we would have been selling into the merchant market and converting those over to the customer side, which is a good thing for us and a good thing for our customers. And we're also looking to take some of the renewable attributes that are generated from our Niagara and St. Lawrence plant and bundle those into new product offerings that we're looking to sell to both existing and new customers to enhance our business there. And lastly, we have behind the meter programs, things like community solar and solar plus storage that we're working on. Down at the bottom half of this slide, we have a volumetric merchant hedging strategy in place. You can think of this kind of like a dollar cost averaging into the market for our merchant generation. So it's reducing our exposure over time. It doesn't do anything to really increase our revenues, but what it does is it gives us more stability of revenues over time. And then lastly, the other way that we can enhance our margins is through cutting O&M and A&G, so reviewing our cost structure. We have a Bending the Cost Curve initiative that I know you've been spoken to about. And so that's something we're looking to do to also enhance our margins. So that's kind of what I had for you today. I'm happy to take any more questions if there are any.
Can I ask a question about, the O&M? I assume Joe Kessler and his people have input into this because they're the ones that have to deal with the system that we have. And is there any concern that we're cutting too close on this O&M so that it impacts the viability of our existing facilities and structures?
If I may, Scott,
Yep.
Judge, excellent question. And I think one thing that we have as a guidepost for us is our asset management philosophy around ISO 55000. That's an area where we can take a look at a hard balance on all the P&Ls of the operating sites and make sure that we're putting adequate maintenance in to keep the reliability that we need for these missions. So that's one of the guideposts that we and principles that we use to make sure that that doesn't happen. Exactly what you described does not happen.
Yeah, that was a very good question. I think, you know, as you know, the team knows, we've talked about all the time, it's all about cutting the fat, but not the muscle. And I know Adam will can get a little bit more into detail about that. But that was a question that I had too, making sure that as we talk about cost structures and creating efficiencies in the work that we do, those are very important because, you know, it's how we be responsible with the capital that we have. But also understanding that what we're focused on is trying to do things that allow us to still function at the best standard that we would expect, that doesn't, you know, risk safety or financial stability at the same time.
Right, I mean, that's correct. I would just add that, again, to your concern, Judge, that our focus is really on sort of discretionary costs or costs that we can control and just trying to do things more efficiently. You know, we spoke about what we're trying to do in the area of our OPEB expense. That's going to be a significant savings. That's not going to impact our operations whatsoever. Things like that, just being more efficient as we do more automation projects, finding ways that we can, you know, reduce over time unnecessary costs that we can harvest from those efficiencies from automation and some of the other initiatives we're doing. So that's where we're going to try to find, you know, more cost optimization from our A&G expense.
Thank you. Great,
thank you. Anything else, Earl and Scott? Any other questions from the committee for them?
No.
Thank you. We'll next turn it over back to you, Adam.
Sure.
You will walk us through Adam is the Chief Financial Officer, EVP, and he'll present the next report, Chief CFO report for the committee.
Yes. Thank you, Chairwoman and trustees and members of staff and the public. If we go to the next, go to this slide. So this is going to be our 5+7 look, and later in the month we'll be presenting the 6+6 at the full board meeting. Time that we had to close the books didn't really afford us the opportunity to get that into this meeting because of the holiday and in the short time in which this meeting was scheduled. But through May, as you can see, we're really tracking towards plan pretty much in all areas. As been said before, really the trends are just the same. Margins from generation are down slightly because of lower hydro flow than we had initially anticipated in our models, and we're getting more revenue out of our transmission that's offsetting that from our new ATRR that's going into effect now through the new transmission year, which begins July 1 through June 30th of next year, as well as the fax revenue that was higher than anticipated. Non-utilities is down slightly, and some of that is a timing issue related to CES and energy efficiency projects, but we expect that to sort of close between now and the end of the year. And operating expenses are tracking pretty well to plan as well right now. A little bit behind on allocation to capital. Again, that's about timing of the spend, and when we see that offset, again, we see that closing towards the end of the year. So that's where we are in terms of actuals through May. If we go to the next page, in terms of our full year forecast, again, with the same trends we see continuing, you'll see more in that transmission because that'll have the full impact of not only the projection of the fax revenue, but also the new ATRR our new annual transmission revenue requirement that went into effect July 1 through June 30th. And everything else pretty much tracking towards plan as we see it today. That being said, in terms of our range below, in terms of our guidance, you'll see that we're saying that we don't expect a lot of downside risk from here based on where we are in our hedging program on the merchant portfolio, but we are projecting a higher upside, up to 20 million higher, 22 million higher between now and the end of the year if certain things get solidified and into place. There's a number of, we always track threats and opportunities for costs that were either unknown or unplanned at the time we did the budget, and then other savings opportunities that we've seen during the year or other things that have materialized. So essentially what we're saying right now is that we're tracking the plan in terms of our actuals, but we see between now and the end of the year the potential to see some upside from where we are today. Are there any questions?
Yeah, Adam, just two questions that I had, and I appreciate that we're tracking well and you think we'll ultimately close the year and I know the team will get at it and close the year as expected. But currently, looking at the numbers, the customer revenue numbers were the softest in our operating income area. And I assume that's related to the discussion we just had in risk around pricing and some of those dynamics. But, what do you see as the thing that's going to help us catch up by the end of the year? Because if we look at by the end of May, I think 2 slides back, about 33 million below what we had expected. So what are your thoughts? We'll catch that up usually through some of the other programs that we're going to talk about today and also going forward so that you feel comfortable we'll close the year pretty well.
And again, what I was saying is that you have to really focus on the margin aspect, which is all the way to the far right, because when we just look at the revenues in certain instances, I'll just use an example, say some of our CNE customers, if for some reason their demand is lower, that doesn't necessarily mean it's going to affect our net income because it may just be a grossing down. So in other words, roughly 50% of the power that we provide to our CNE customers, which are some of our largest, we essentially buy in the open market and pass through to them. So if their demand numbers are down and prices are down from what we were projecting, well, the revenue number is going to look lower, but our purchase power and our expenses related to that are going to be lower as well. So that's why we want you to focus on the margin view, which is all the way to the right. And again, that's just going to track what we've been seeing all year. So we don't see anything there that's going to get any worse in terms of its impact on our margins or our net income. And it really won't get much better either because we're pretty stabilized there because it is a lot of that is just a pass through. So it's really what's going to happen on the expense side. It's going to be the thing that will determine where we end up between now and the end of the year.
Thank you. And just one other question that I had, I mean, it's a small number, but it stood out to me, the fuel consumed number for the first half of this year. Is that just because, we weren't driving as much as activity starts to kick up? What contributed to that number for the first half?
I think what you're seeing there is that's reflecting some of the increases that we're seeing in the uptick in natural gas prices, as Scott was saying. So there is an aspect of that that's impacting us on the expense side as well.
Okay, great. Thanks.
Are there any other questions on this? And again, I'll have a further update right between now and the end of the month on our June and our forecast out. And again, we didn't have time for it, but just to tell you that June again is tracking again towards plan. So we continue to see the same trend.
Great. And no, I just want to state that there are no, this was just an update. We don't need to, no vote is necessary, just as no vote was necessary on the update from the risk team. So thank you. Adam, the next item.
Thanks. So the next item is is an approval for our energy efficiency conduit program we've been talking about over the last year or so. And this is going to enable our customers to get long-term financing on a fixed rate basis, better than we can essentially provide them today. So it's a benefit for not only NYPA, because some of the loans will be moving from our balance sheet, off balance sheet through a conduit, but at the same time, it's going to afford our customers the ability to fix their rates going out into the future for any length of term from 10, 20, up to 30 years. There is a piece in the consent agenda, which is also going to allow a longer term than is currently available under a resolution to go from 25 to 30 years, only for as it relates to the conduit program, because that'll be no impact on NYPA. So in our conversations with our customers, and given that really back in March when rates started going up and all the talk about increased inflation and the worry that rates may eventually start to tick up, our customers have been very interested in this program because it would afford them that long-term fixed rate option. So this program before you today is to authorize NYPA to issue up to $250 million of separately financed project bonds, which will be treated under GASB 91 as conduit bonds. So it would be off credit, off balance sheet, be in the notes of our financial statements, but it's really going to be an obligation of the underlying customers who are in the program. So again, we've been talking to our customers and they see this as a potential real benefit for them going forward, not only on the rate side, but again, it allows us to really ramp up our energy efficiency business without limitation going forward. So it's going to really help our business, and it's going to help our customers get their business done. Is there any questions?
And Adam, this was just a mechanism for us to lend our strength to help our customers access what we think is important, the energy efficiency goals that we have set, the state has set, right? And then and we've talked about the banks that are participating in our previous meetings. We've already approved those who are participating in this conduit program. So this is just, we're moving forward with it. We're ready to get started. The team has lined up the customers who want to participate in the program. And we're, again, bringing that NYPA strength to help them get the best rates possible.
That's correct.
Any questions from the committee? If there are no questions, I'll ask for a motion to recommend this item to the full board for adoption.
So moved.
If I could get a second.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thank you, Adam. We'll now turn it over to Chris Fry, Director of Business Development, and he'll present the next item on this.
You may want to tee it up.
I'm sorry, did I hear someone?
Yes, Madam Chair, it's Gil Quinones. I just want to set the table for this before Chris presents. We have, and it's written here, we have the Climate Leadership and Community Protection Act, the law that was passed in our state, where all electricity consumers are required to have 70% renewable by 2030. And you will hear from Chris on how we are going to help our customer comply with that requirement. Originally, we were we thought about doing this by issuing RFPs and contracting directly with large-scale renewable developers. But then when we did a couple of those RFPs, we learned that it's much better if we deal with our sister authority, NYSERDA, and Chris will explain that, because our customers do not necessarily want to get tied up on long-term contracts when it comes to their compliance for renewables. And from our perspective, it uses up capacity in our balance sheet that we could use otherwise in, say, financing transmission or financing energy efficiency projects for our customers. So we believe there is a much better use for our balance sheet capacity than doing long-term contracts. So we found a way in partnership with NYSERDA, New York State Energy Research and Development Authority, to help our customers effectively and efficiently comply with the goals of the Climate Leadership and Community Protection Act. Chris?
Thank you, Gil. Good morning, trustees, colleagues, and members of the public. It's my pleasure to present to you today to request that you recommend to approve the Renewable Energy Certificate Purchase Agreement that we're seeking to execute with NYSERDA. In a nutshell, the purpose of this agreement is to support our achievement of our Vision 2030 strategy and our customers' achievement of New York's 70% by 2030 renewable energy goal. Renewable energy in New York is traded in the form of renewable energy certificates, or RECs, and NYSERDA conducts annual solicitations to purchase RECs from new to-be-constructed renewable energy projects. NYSERDA then offers the RECs that are produced from those projects for sale to load-serving entities to help their customers meet the CLCPA goals. This agreement will enable NYPA to begin purchasing RECs from NYSERDA starting in 2024. And since this is a Finance and Risk Committee, I'd be remiss if I didn't mention that we'll of course recover the associated costs from our applicable customers under their existing electricity supply contracts. Next slide, please. So to give you a little context, this graph shows the composition of New York's 70% by 2030 renewable energy goal. The CLCPA includes a number of distinct categories of resources, which they refer to as tiers. Shown there at the bottom as the dark blue foundation is New York's baseline renewable energy supply, which is generated by projects that predate the Clean Energy Standard, and the majority of which is NYPA's hydro. On top of that, the yellow wedge represents New York's 6 gigawatt distributed solar goal. The light blue wedge all the way at the top reflects New York's 9 gigawatt offshore wind goal, and the orange wedge below that is the recently introduced new category, which they're calling Tier 4, which includes renewable energy specifically delivered to New York City. Last but not least, the green wedge in the middle represents Tier 1, which consists of new utility-scale renewable energy projects, primarily land-based wind and utility-scale solar. The REC agreement that we're seeking to execute with NYSERDA is specifically for Tier 1 RECs to help our customers achieve that component of the CLCPA goals. Next slide, please. So to delve into just a little more detail, shown here at the top right is a graph of just that green wedge, the current and forecast Tier 1 REC goals for New York. As you can see, it starts low at only 2% this year, but quickly ramps up to over 8% by 2023, and it's projected to increase to over 15% by 2030. Given that ambitious trajectory, this agreement is a timely and important step forward in helping our customers achieve the CLCPA goals. From a financial perspective, this agreement will have zero net cost to NYPA. Our REC purchases under this agreement will be based on the volume of RECs that we can pass through to our customers under their existing contracts. In terms of timing, starting in 2024, NYPA will participate in NYSERDA's regular quarterly REC sales and will subsequently invoice our customers in the normal monthly cycle. In conclusion, the impact of this agreement to our customers is that it's a cost-effective and low-risk avenue to help them achieve the CLCPA goals. And the benefit to NYPA is similarly significant from a clean energy perspective, while the impact is minimal from a finance and risk perspective. So that concludes my presentation. I'd be happy to take any questions.
Chris, I guess two questions that I had, or comment and a question. So I appreciate how you've laid this out and Gil's introduction to this topic, because we have looked at this and various different approaches to this. And I appreciate this is another example of NYPA stepping in to bring their position of strength, their knowledge. We are players in this space, so understand it better and can help our customers have access to RECs. So one question that I had is, we obviously are also pursuing large scale projects ourselves. And so we're going to tap into this market that NYSERDA is pursuing and buy RECs through that. Have we thought about, you know, how we could also take it, how this might compete, may or may not compete with the RECs that will come from the projects that we are participating in directly? Why is that not an avenue for purchasing RECs as opposed to participating in this NYSERDA process?
Thank you for the question. So those avenues are really not in competition. They're complementary. We've already identified that there's a portion of NYPA's customers base for whom purchasing RECs through this agreement would be preferable than entering into a long-term agreement to support the development of a large-scale renewable project that NYPA would contract for. However, we continue to work with our customers and identify the approach that makes the most sense for them. And for some of our customers, that may be large-scale renewable projects, but there's a portion of NYPA's customers for whom they're not interested in entering into long-term contracts. And so entering into this agreement with NYSERDA provides us with an avenue to purchase renewable energy credits. We'll have the flexibility under this agreement to adjust the amount of renewable energy credits that we purchase from NYSERDA based on our customer demand.
Any other questions from the committee? Thank you, Chris.
Thank you.
We'll now turn it over to Trish Lombardi, SVP Project Delivery, who'll present the next item on operations. Trish?
Good morning, Chair McKibben. Committee.
Madam Chair, I think we need a motion on Chris's item.
So
sorry about that. If I could get a motion to recommend this item to the full board for adoption.
So moved.
Second.
Moved and seconded. All in favor, say aye.
Aye.
Any opposed? Motion carried. Thank you, Gil. All right, back to you again, Trish.
Thank you. Good morning, Chair McKibben, committee members all. I'm here today to present one item on behalf of operations and NYPA development. This is the capital expenditure request for the Smart Path Connect project. So today we're requesting that the Finance Committee recommend a capital expenditure authorization in the amount of $595 million to continue development and implementation of the Smart Path Connect project to the full Board of Trustees. This project, formerly referred to as the Northern New York Priority Transmission Project, is a result of the New York State Accelerated Renewable Energy Growth and Community Benefit Act, and its objective is to accommodate the firm transfer capability of 1,000 megawatts from the northern region for future renewable generation growth, reduced generation curtailment, improved efficiency of energy pricing in New York State, amongst other benefits. This priority transmission project was approved by the Public Service Commission in October 2020. Subsequently, at the March 2021 board meeting, the authority recommended and the board approved the acceptance of this project and the co-participant agreement with National Grid. Together, the authority and National Grid will rebuild approximately 100 miles of 230 kV and 345 kV transmission lines, construct 3 new substations, and expand and/or upgrade 8 existing substations. The development and planning of this major project is ongoing, with a major milestone reached in mid-June with the submission of the Article 7 application. The total project is estimated at approximately $1.05 billion, with the authority's share being approximately $605 million. To date, $10 million in capital funds have been approved, so the current request of $595 million will authorize the balance of funds required to complete the project. While staff is recommending the approval of all capital funds required to complete the project today, at this time, expenditures will be limited to $20 million as cost recovery is secured in accordance with the NYSO tariff requirements and appropriate approvals from the FERC are received. These cost recovery proceedings are currently ongoing and are expected to continue through the end of the year. Proposed spending for this project is included in the 2021 budget and in the 4-year capital plan previously approved by the board. Thank you. I'll now take any questions.
Trish, just sort of more of an administrative question that I had, because obviously we're approving this and we've talked about this. This is part of a larger project request that the board has approved. But we're doing this next step, and you explained that we're currently before the regulators to get approval for that, but we approve this even before we get that clearance, so to speak, from FERC. But we're comfortable just generally in our usual operations and the way we usually approach this, that we'll get the approval we need to be able to recover these amounts. Yes, I just wanted to confirm that.
Yeah, as I said, I think that's the reason we're coming to the board today. We were just there in March presenting the project, acceptance of the project, and approving National Grid as the co-participant. But today we are recommending the full approval of the capital expenditures because we do feel confident going forward with the cost recovery proceedings. But to minimize risk and minimize exposure, that's the reason we're going to hold expenditures to $20 million while the cost recovery proceedings are moving. We're trying to balance a very aggressive schedule and the cost recovery. So we're maintaining those internal controls and limiting risk by limiting that expenditure until the cost recovery proceedings are completed, which are scheduled by the end of the year.
Thank you. Any other questions from the committee? There being none, there is a motion that needs to be sent forward. If I could get a motion to recommend this item to the full board for adoption.
So moved. Second.
Moved and seconded. All in favor, say aye.
Aye.
Any opposed? Motion carries. Thank you, Trish.
Thank you.
We have a consent agenda that the committee members have had a chance to review. If there are no questions, I'll ask for adoption. If I could get a motion to adopt the consent agenda before the committee.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Aye. Motion carries. So this is when we will do the change. We'll now move into, I assume there's still a need. I'll do a check with the management for an executive session. We're finished with all of the formal public session of this meeting. So now we would move into an executive session. Is that still the plan? If I could just get a check from.
Yes, Madam Chair, we have a couple of items.
Okay, so the next portion of this meeting will be held in executive session, and I'll ask for a motion to conduct an executive session to discuss the financial and credit history of a particular corporation pursuant to Section 105F of the Public Officers Law.
So moved. Second.
Moved and seconded. All in favor, say aye.
Aye.
Any opposed? Motion carries. We will move into executive session. Thank you. Motion to resume this meeting in open session.
So moved.
Second.
Moved and seconded. Motion. All in favor, say aye.
Aye.
Any opposed? Motion carries. There were no votes taken during our executive session. The next joint meeting of the Finance and Risk Committee will be held on September 21st, 2021. I'll now ask for a motion to close the meeting.
So moved.
Second.
Moved and seconded. All in favor, say aye.
Aye.
Any opposed? Motion carries. Thank you, everyone. Great job, team.
Thank
Stay
you.
healthy.
Take care.
Yes,
Enjoy your summer.
and stay cool.